Have you ever noticed what happens every time there's a major news event, an FOMC announcement? Inflation data, non-farm payrolls, or rising geopolitical tensions? The market suddenly becomes extremely volatile. Gold spikes. The US dollar moves aggressively. Social media fills with traders saying, "Buy gold, sell the dollar." This is the move we've been waiting for. But here's the question most traders never ask. Who is actually on the other side of those trades? Because while retail traders are reacting to the headlines, institutions are often reacting to something completely different. They're reacting to liquidity. And once you understand that difference, you'll never look at news the same way again. Let's think about this for a moment. When major news is released, does the news itself move the market, or does it simply create the conditions institutions need to move the market? There's a big difference. News creates emotion. Emotion creates orders. Orders create liquidity. And liquidity is exactly what institutions need. Large institutions can't simply place enormous buy or sell orders whenever they want. They need willing buyers. They need willing sellers. They need enough market participation to execute large positions without dramatically moving price against themselves. Major news events provide exactly that. Major news events provide exactly that. Fear, excitement, panic, FOMO. Thousands of traders enter the market within seconds, and that creates the liquidity institutions have been waiting for. This is why I don't begin my analysis by asking, should I buy gold? Instead, I ask 3 questions. The first question is, where is higher time frame liquidity? Before I even think about entering a trade, I want to know where institutions are likely interested. Previous days highs, previous days lows, weekly highs, weekly lows, equal highs, equal lows, major swing points. These are the areas that matter because institutions don't chase headlines, they trade toward liquidity. The second question I ask is this genuine repricing or just an emotional reaction? This is one of the biggest mistakes retail traders make. They assume the very first move after the news is the new direction. Sometimes that's true, but many times it isn't. The first move is often driven by emotion. It attracts traders into the market. It creates liquidity. Only after that does price begin revealing institutional intent. That's why patience is one of the most valuable skills a trader can develop. The third question I ask is price sweeping liquidity before revealing its true direction? This happens far more often than most traders realize. Price pushes above a previous high. Everyone believes the breakout has started. Then price reverses. Why? This happens far more often than most traders realize. Price pushes above a previous high. Everyone believes the breakout has started. Then price reverses. Why? Because the objective wasn't necessarily to continue higher. The objective was to collect liquidity sitting above those highs. Once enough liquidity has been collected, the real move begins. That's why I rarely chase the first candle after major news. I wait, I observe. Then I let price reveal what institutions are actually doing. News creates volatility. That's why I rarely chase the first candle after major news. Liquidity creates opportunity. I wait, I observe, and then I let price reveal institutional intent. Let's apply this thinking to events like an FOMC meeting or geopolitical tensions in the Middle East. Most traders immediately focus on the headlines. Interest rates, inflation, military conflict, political statements. All of these events can create enormous volatility. But volatility alone doesn't tell us where price is going next. Instead of reacting emotionally, I ask myself, has price reached higher time frame liquidity? Is this simply an emotional spike? Or is the market genuinely repricing? The answers don't come from the news. They come from the chart. This is exactly how we approach the market inside the Fundex framework. We don't trade because the news sounds bullish. We don't sell because the headlines sound bearish. We begin with structure, then liquidity, then market narrative, then our execution zones. Finally, We wait for confirmation before taking any position. Notice what's missing. Prediction. We don't need to predict. We simply allow price to reveal where the highest probability opportunity exists. That's what keeps us disciplined. That's what keeps emotions under control. And that's what creates consistency over time. So the next time a major news event hits the market, whether it's an FOMC announcement, CPI, non-farm payrolls, or geopolitical tensions, don't ask yourself, should I buy gold? Instead ask, where is liquidity? Is this emotional or institutional? Has price revealed its true intention, or is it still collecting orders? Because remember, news creates volatility. Liquidity creates opportunity. Learn the difference. And you'll stop reacting like the crowd. You'll start thinking like a professional trader. And you'll stop reacting like the crowd. You'll start thinking like a professional trader. If you enjoyed this video and want to learn how institutions really move the market, subscribe to the channel for more videos on liquidity, market structure, and the Fundex framework. If you're serious about becoming a consistently funded trader, you'll also find a link below to join the free Fundex Trading Academy. Inside, you'll learn the same structured approach I use to analyze the markets, manage risk, and develop the discipline needed to trade with confidence. Until next time, master the market, master yourself, master the market, master yourself, master consistency. Trade with confidence. Subscribe for weekly institutional market insights.